Maria had $400 left in a $900 account. One trade did that. She was long the British pound against the South African rand, a pair she had never really looked at closely, and the spread alone was eating her position before price even moved a pip. She thought a currency pair was just a currency pair. It is not. Today we rebuild the whole idea of what a pair actually is, using her mistake as the map, so you never make the same click she did. The exchange rate is simply the price of one currency measured in another, and it never sits still because it is a constant tug of war. Stronger data, higher interest rates, more global demand pulls a currency's value up. Weaker data pulls it back down. That tug of war exists on every single pair on Earth without exception. But here is what Maria missed completely. Some of these tug of wars have thousands of players and deep pockets on both sides, and others have almost nobody home. That difference has a name, and it separates the pairs worth trading from the ones that quietly wreck accounts. The majors are the 7 pairs that dominate global Forex volume, and every single one of them has the US dollar sitting on one side. Euro dollar, dollar yen, pound dollar, dollar franc, dollar Canada, Aussie dollar, Kiwi dollar. They trade around the clock in an enormous size because the biggest economic engines on the planet are constantly transacting against the world's reserve currency. Maria's rand pair had no dollar in it at all. That single fact changes everything about how a pair actually behaves. And it comes down to one word we have not defined yet: liquidity. Liquidity is just how much trading activity is happening in a pair right now, how many buyers and sellers are stacked and ready. Euro dollar alone moves over $1 trillion a day. Picture that as a deep pool you can cannonball in and barely make a splash. Maria's pound rand trades a tiny fraction of that volume. Same size cannonball, and the water practically empties out. Spreads widen, price gaps, slippage eats the trade alive. This is the part of her account statement that told the real story before the trade even had a chance to lose. Cross pairs, often called miners, take 2 major currencies and pair them directly with no US dollar involved at all. Think euro against the pound or pound against the yen. They trade less than the true majors, but they are still backed by 2 heavyweight economies. So liquidity stays healthy and spreads stay reasonable. This is the middle tier that Maria should have understood existed. Below the miners is where things start getting dangerous, and that is exactly where her actual trade was sitting. An exotic pair takes one major currency and pairs it with a currency from a smaller or emerging economy: dollar against the Turkish lira, pound against the South African rand, the exact pair that drained Maria's account. Lower liquidity means wider spreads are baked into every trade before price even moves, and it means a single headline, a rate decision, a political shock can gap the price violently. Remember this because it applies everywhere in trading. Context beats shape. It is not what the pair's letters look like on screen. It is which category it sits in that decides how dangerous the trade really is. Before I show you, pause the video and try to name the 10 currencies traders call the G10, the most heavily traded, most liquid currencies in the entire world. Got your list? Here they are: US dollar, euro, Japanese yen, British pound, Swiss franc, Canadian dollar, Australian dollar, New Zealand dollar, and 2 Scandinavian currencies. Most beginners forget entirely: the Norwegian krone and the Swedish krona. Every major pair we just covered is built from names on this list, which raises a natural question: what exactly are these Scandinavian currencies, and why do only 2 of them make this cut? The krone, the krona, and another krone, Norway, Sweden, and Denmark each have their own version, plus Iceland's krona, and traders lump them together as the Scandies. They share more than a name. In the late 1800s, these countries actually ran a monetary union with a shared fixed value, and that shared history still echoes today. These currencies often move together on the same regional data and the same interest rate cycle. Not far away on the other side of the old Iron Curtain sits a completely different cluster of currencies with a very different personality. CE stands for Central and Eastern European currencies: the Polish zloty, the Hungarian forint, the Czech koruna, among others. These sit a notch below the Scandies in liquidity and lean more toward the emerging end of the spectrum, sensitive to European central bank decisions next door and to their own regional politics. Not quite exotic, not quite major, their own lane entirely. Now, zoom out even further, because there is a bigger grouping that shapes how all these currencies get talked about in the news, and it is not even primarily a Forex term. BRICS, sometimes written BRICS, to include Indonesia, started as a label for major emerging economies: Brazil, Russia, India, China, South Africa, and the group has kept adding members since. It is not a currency pair category you trade directly, it is context. When this block makes a joint statement about trade or reserves, currencies like the rand, the real, or the rupee can move on the headline alone, which is exactly the kind of event risk that hits an exotic pair hardest. This is the missing piece from Maria's story. She was not just holding a thin pair, she was holding one wire directly into this kind of macro noise. Step back for a second. Every pair we have discussed, majors, minors, exotics, is really just one currency written over another, base currency on top, quote currency on the bottom, the number telling you how much of the quote it takes to buy 1 unit of the base. Pound over Swiss franc, euro over yen, same format every single time. The United Nations officially recognizes roughly 180 currencies across its member states. That is the raw ingredient list for every pair that could ever theoretically exist. So how many combinations does that actually produce? Take those 180 currencies and pair every single one against every other one. And because buying dollar yen is a different position from buying yen dollar, direction counts separately. Run that math and you land north of 32,000 theoretically possible currency pairs. Sounds massive. Here's the gut punch. Almost none of those 32,000 ever actually trade anywhere. Out of those 32,000 plus combinations, the number your broker actually lists is closer to 50 or so pairs with any real volume behind them. The majors, the minors, and a curated set of exotics. Everything else exists on paper only. No market maker willing to quote it, no liquidity to fill it. That gap between what is mathematically possible and what is actually tradable is this whole lesson in miniature. Maria was not trading something impossible. She was trading something technically real, but practically thin. And thin is exactly where accounts die. This is Eurodollar live right now, the single most traded pair on the planet and the best training ground for everything we covered. Watch how tightly these candles sit against each other, how price moves in smooth, small steps instead of sudden gaps. That smoothness is liquidity you can literally see. Before you ever risk real money on any pair, pull up its live chart the same way and ask 3 questions. How tight is the spread sitting right now? How jagged or smooth are the wicks compared to what you just watched here? And is a major session actually open at this hour? Run that check before your next entry. And Maria's mistake stays hers, not yours. Remember, context beats the pattern. The stop is what saves you, and nothing replaces practice on a live chart.